Assalamualaikum. Welcome to video 36 IFRS 16 leases. Now leases is applicable for both SBR and FR students. First, you have to identify a lease. So lessees are the one who has taken a lease. Okay. Lessor is the one who has given the lease to the lessee. So the lessee have to recognize two things. One, the right to use that asset. Second, liability because they have taken a lease. So they have to recognize asset and liability for all the leases unless the lease is for short term or it's of a minimal value. So it is vital to assess whether a contract contains a lease or whether it is simply a contract for service. If it's a contract for service, you have to apply the rule of IFRS 15, that is revenue from contract with customer. If the contract contains a lease, then you have to apply the rule of IFRS 16. A contract contains a lease if it conveys the right to control the use of an asset for a period of time in exchange for a consideration. Lessee accounting. So in lessee accounting, if the lease is short term, that means less than 12 months, or of a low value, lessee can choose to recognize the lease payment in the profit and loss as an expense. Okay. In all other cases, IFRS 16 requires the lessee to recognize lease liability and the right of use asset. So the asset that they recognize for using that asset is known as right of use asset. Okay, and lease liability when you start the lease. Now, the right of use asset, initially it is measured at cost. So the initial value, how are you going to measure the lease asset? The initial value of your lease liability, of course, the amount that you have to pay will be your asset also. But with that, you have to add any lease payment made at or before starting of the lease as well as any direct cost. The right of use asset, like any asset, will subsequently be depreciated. So cost less accumulated depreciation and impairment loss. Unless another measurement model is chosen, for example, you are revaluing it. But usually they will not give you revaluation for right of use asset. When it is leases, it is at cost. Lease liability is initially measured as the present value of the lease payment that have not been paid. Usually they will give you the amount. You don't have to discount or find the present value. They will give you the present value of the lease payment. So you can take the figure as it is. The carrying amount of that lease liability will be increased by the interest charge, because any liability, interest also will be charged and interest is added to the amount, just like loan. Same for lease liability also. It will be increased by the interest charge, which will be recorded in the statement of profit and loss. Any cash repayment that you are doing will reduce your carrying amount of the lease liability. Same like how loan works. Okay. Now, lessor accounting. So one side we have lessee accounting who has taken the lease. They will record right of use asset or lease liability. On the other hand, the one who is giving you the lease, lessor, he is known as lessor. Lessor accounting, they will recognize either a finance lease or an operating lease. What is a finance lease? A finance lease means the risk and the rewards of the ownership is transferred to the lessee. And the operating lease means risk and ownership does not transfer to the lessee, it remains with the lessor. Okay. So let's first understand some key indicators of a finance lease. They are: ownership of the asset transfers to the lessee at the end of the lease term. Lessee has an option to purchase the asset at the end of the lease term or to continue to lease it for less than the fair value. Lease term is the major part of the asset's economic life. The present value of the lease payment is the substantially all of the asset's fair value. So if this condition things are there, it's a finance lease. Now, if the lease is a finance lease, the lessor will de-recognize the asset. Why? They have given the asset to the lessee. Lessee has taken the ownership of the asset. So why will lessor recognize the asset any longer, right? They will de-recognize the asset. Rather, they will recognize a lease receivable because they are going to get that amount from lessee. So lease receivable, which will be equal to the net investment of the lease. That is the present value of the payment. They will recognize an interest income also that will arise on the lease receivable, which will be recorded in profit and loss. If the lease is an operating lease, lessor will continue to recognize the asset. Okay, so they will recognize the lease income in the profit and loss over the lease term. Now, sale and leaseback. This is also a very common scenario which is often tested. That is, when you first sell the asset and then you're using the asset as a lease back. So you're not owning the asset any longer, you are selling it and then you're using it under lease. So in this case, you have to see the transaction whether it represents sale or not. If it is a sale, you have to use the rule of IFRS 15, and if it is not a sale, then we'll see. So this table will help you a lot. Transfer is a sale, transfer is not a sale. So if the transfer is not a sale, from the lessee's point of view, how they will recognize, and from the buyer, who is the lessor, how they will recognize. Okay. If it's not a sale, lessee will continue, the seller is the lessee here, okay? They will continue to recognize the asset because it's not a sale. So they will recognize what? A financial liability. Why? Because they have to pay now. See, it's a seller, lessee, right? They have sold and they are leasing back. When they lease back, they have now they are taking the lease. So they have to pay that amount. So for them, it's a financial liability. They have an obligation to pay to the lessor, to the buyer. So they will recognize a financial liability equal to the proceed that you have received from selling, which is not a sale. So that proceed that they have received is equal to the financial liability. On the other hand, lessor, they will not recognize the asset because it's not a sale. We have now sold them to the lessor. They will recognize a financial asset equal to the transfer proceed. So lessee will recognize financial liability, lessor, they will recognize financial asset because they have the right to receive that amount from the lessee. This is when it's not a sale. But if it's a sale, seller, the lessee will de-recognize the asset and they will recognize a right of use asset. But here, complication arrives here. When you recognize a right of use asset, it's not the full amount. It is the proportion of the asset's previous carrying amount that relates to the rights that is retained. Of course, the amount that is not retained, how can you recognize it? You will only recognize to the rights that you are retained. Recognize a lease liability. Lease liability, not financial, lease liability, because it's a sale. Because now you have taken a lease. So it's a lease liability for you. And because it's a sale, profit and loss will come. So that profit and loss will arise on disposal. Buyer, on the other hand, they have purchased that asset from the lessee. So they will account for the asset purchase. They will account for the lease by applying the lessor accounting treatment. That means for them, it could be a finance lease if they have taken the control at the end of the lease, or a operating lease if they have not taken the ownership. Now, let's go through this example. So N is selling a property to F for 20. Property has a carrying amount at the date of disposal of 7. N enters into a contract to lease the property back from F for 5 years. Present value is 5.7. Now, if the sale and the leaseback transaction represents the satisfaction of performance obligation in accordance with IFRS 15, that means it's a sale. N, who is the lessee, has to recognize a right of use asset at the proportion of the asset's previous carrying amount that relates to the rights retained. Okay, so this is how you get it. Assets previous carrying amount. So what is the previous carrying amount? The present value of the lease payment is 5.7. That is the present value of the lease payment. They are selling the property for 20. So 5.7 over 20 into 7. This 7 is the property at a carrying amount. So right of use asset will be recognized at 2 million. This proportion you have to know. Okay. So a lease liability will be recognized for the present value of the lease payment, that is 5.7 already given to you. But right of use asset you will recognize at 2 million. Now, so the double entry, debit cash 20, because you're selling, you are receiving the cash, and you have to debit the right of use asset because it's a sale and you have taken it under lease, so 2 million, and then you have to credit the lease liability 5.7, and also you have to credit property, plant and equipment because you are selling it, the carrying amount, that is 7 million, and you have to credit the profit on disposal. Remember, that is this is a balancing figure. Your debit side has to always balance your credit side. So it's the profit on disposal. because the balance came on the credit side. Okay, 9.3. Now, if the sale and the leaseback transaction does not represent a sale, then N will continue to recognize the asset within its BP and will recognize a financial liability for the proceeds that they have received, which is 20 million. Okay. Now, these are the exam kit questions that you have to do. That is Laria, Crypto, Anog, Cherry, STEM, and Bohai. So thank you for watching, and with this I've finished almost all the standards. Now it's your job to do all the questions from all the standards from your revision kit as well as some past papers for both FR and SBS students. Thank you for watching.